things that a lot of us are asking ourselves is, does the stock market have to rally just because expectations are high that the Federal Reserve is going to cut rates starting with the March meeting? So there's three big points here for this discussion to be useful and measurable and hopefully something you could put to work right away. First of all, what is the history of the years where the Federal Reserve has cut rates? And in this current issue of the Top Tier Outlook, one of the sections was a history of the FOMC rate cuts. And this is just that blurb from the current report that's out for the January 15 Top Tier Outlook, which by the way is part of the Sector Secrets Mastery membership. And you can see here, I went back to recent memory. I went back to years that I was trading, and I'll tell you what, that 1998 was a big eye opener for me. We'll get to that in a moment. So the first thing is, we're going to answer what was the response after these rate cuts. The second thing is, quite frankly, how do we measure what bullish sentiment, bullish momentum, and a bullish trend is? Those are the three big questions. What is sentiment? What is momentum? What is trend? And I'm going to tell you from the perspective of all last year, if not telling people to look for the long side of the equity markets, NASDAQ and S&P mostly, if not practically begging folks to stay bullish the NASDAQ, the reason was a very easy to follow process that I've been using for darn near 30 years to understand sentiment, momentum, and trend. All right, so we'll get into that as well. And how I do it. And the third thing is, well, what do we want to do now? Right? What is the trade? So let's get to it. This is going to be a pretty in-depth video, but again, let's start off the year with making decisions based on what we see, not what we think. I tell the traders in the mastery all the time, we trade what we see, not what we think, not what we feel, right? None of that stuff. And not the gut, none of that stuff. So let's get to finding an actionable and objective process based on what we see. Here's the NASDAQ. Now, if I go back, and let's do this together. If I go back to 1998, and at this point I've been trading, at 1998 I was trading full-time for about 8 or 9 years at this point. And this was the first massive currency crisis that I dealt with. Some of you might remember the ruble crisis, the Asian contagion, and the implosion of long-term capital management. This was the first major, oh my gosh, that I had traded through full time. Now, I had traded Gulf One from my dorm room, but 1998 was just a trifecta of craziness. And the Federal Reserve cut 3 times with half-point cuts in response to the currency crisis. And this would have been in 1998. And you can see here, and my chart cuts off, but here's 1999 to early 2000. Now remember, this was a NASDAQ at 2,200. A move to, that was a doubling. And you might say, wrong, there was a lot that happened in that window, right? But remember, in a lot of ways, long-term capital management's implosion, the response to the Asian contagion, the ruble crisis, and a 3 half-point cuts in the Fed, we can say easily fed the dot-com boom. All right, so now we go from the dot-com boom to 2001. All right, in 2001, in response to the bust, which we can argue was a boom they created in response to those things that happened in 1998, we saw a rate, this was unbelievable at the time. Remember, we had in 2001, not only the tech bubble burst, we also had September 11. And you go forward from there, the Federal Reserve took rates from 6% to 1.75. So by 2002, and this is this low in here, by 2002, and if I kind of shove this over, actually I can't. If I take a look, by 2002, rates were slashed, right? You go into November 2002, June 2003, and Fed funds rate ends up at 1%. Now, Subsequently, this led to 2 years of hiking between 2004 to 2006 in response to the housing boom. But rates were so low, this, of course, set up moral hazard and 2007 housing crash. Now, these moves look quaint by comparison to what we have now. But remember, back then, these were huge moves as I kind of scroll in and show you what this looked like. So think of it this way. So far, we know that in 1998, the Fed cut rates and we saw what happened. Okay, boom. We know that in 2001, the Fed was responding to a number of things. Did it launch off right away? Well, remember, rates were cut in 2002 and 2003 as well. So here's the beginning of 2003. And there we go. We're starting to move higher once again. So when folks ask, Rog, do equity markets have to launch higher on the Federal Reserve cutting rates? No, but it sets the scene. It gives the equity markets inexpensive capital. Now, the most significant, let's just use one that a lot of us might remember and traded through. 2008, in response to the Great Recession, rate cuts began with a half-point cut, taking Fed fund futures from 2% to 1.5%, and then ultimately landing at 0.25% by the time we got to December 2008. So that's right where this is. I'm going to put my drawing. This is huge, gang. Some of the lowest rates we'd ever seen. This was in response to the Great Recession. This is in response to the housing market. This is in response to, as famously in the movie, GE said, I can't get a loan. We make light bulbs, right? Or as one of my buddies said, Rog, we got so close to people putting their ATM card in a bank ATM machine and the card not being given back. I mean, this was a huge liquidity crisis. A lot of us traded and lived through that. There's been nothing really like that ever since. And I would not consider the pandemic on par with what happened in 2008, just in terms of the scale of what was happening in terms of a financial crisis. Obviously, we'll talk about 2020 in a moment and what happened there and the Federal Reserve's response. Take a look at what happened. 0.25 point. That's where the Fed funds rate were. Not only did it start to trigger the overall movement for us, for as long as rates were low, we continue to see what happened. All right. So yes, I mean, so far you can see to varying degrees, it doesn't trigger the uptrend, but it sets the stage for it. We don't want to be bears as we go into 2024 with the Federal Reserve ready to do another dovish pivot. In 2019, this dip, which looks like nothing, it looks cute, like a teddy bear by comparison. But I will tell you, at Q4 2018, Jerome Powell decided to ignore the expectations that the FOMC would pause. So for those of you wondering, could Jerome ignore that again? He did that back in 2019. And this tiny little sell-off was one of the biggest sell-offs we had seen. And I'm going to go to the ES just for comparison's sake, so we're not just on the NQ. There is, here we go, let it populate there. So let's go back to, 2019. And this little dip here, right, was huge because Jerome decided to ignore expectations that they were going to pause. Now, up until that point, and that was a pure panic because the Federal Reserve was not responding to what traders and investors were calibrating to, which was pausing the rate hikes. And in fact, what he did instead was another 0.25 point hike. Q1 of 2019, the floor fell out from under all of us in terms of support, buying demand in equities. Now, that was clearly overshadowed by the pandemic. But once again, after 2020, in response to the pandemic, the FOMC cut back to that 0.25 point Fed funds rate with a 0.5 point cut, which is big in and of itself. 13 days later, they cut a full percentage point. Unheard of. What happened in the wake of that? One other thing happened. The Federal Reserve decided to empower the Treasury through the special purchase vehicle to buy stocks, to buy high yield junk and high yield bonds, HYG, JNK. Changed everything. Off to the races. Again, does the Federal Reserve shift in monetary policy to a more accommodative stance make a difference? You bet. And that's where we're sitting right now. So there's a 10-minute history of, does the Federal Reserve set the stage with a more dovish approach to monetary policy? Does it set the stage for an uptrend? It does. All right, let's go back to the daily time frame now. So I mentioned I'd show you how to understand sentiment, momentum, and trend. And let's use an example. All of 2023, I all but implored people to stick to the long side. Why? Number one, sentiment. If you're on a daily time frame, look at the 200 exponential moving average. Not as simple. Look at the exponential. It builds within it a recency bias. More recent price action is heavily weighted into an EMA as opposed to an SMA. Both are fine. I prefer EMAs. The longer we spend above the EMA, it's as if we're in the bullish hemisphere. Think of that 200 as the equator. Very powerful to say sentiment is generally going to be more bullish when a daily time frame is above its 200. By the way, this works on a weekly too. Sentiment. All right. What about momentum? We know that if momentum continues, momentum can ultimately yield a trend. So sentiment, momentum, trend. Really easy, gang. Take a look at the bottom of my screen. I like to say I build every trade from the bottom up. These two rows of colors are momentum and trend. Now, I've got a slow stochastic slicing and dicing through this. So just for the sake of this video, what I'm going to do is just remove that here for now. By the way, before I remove it, take a peek. Anytime the trend is neutral, this is mostly neutral in here, these are going to be overbought and oversold signals. So this is a slow stochastic, best oscillator I've ever used. Please, gang, an oscillator means what? Going back and forth. It's not about trends. We don't want something that looks at overbought and oversold when a market is in an inherent imbalance in the context of a trend. So when you have a choppy market, how are you identifying it? And then use something like a slow stochastic. I've given you all my settings for eons, 21K, 3D, overbought 80, oversold 20, exponential. Once again, that recency bias being built into it. Listen to me now, believe me later, you won't find anything freer and more effective. I've been using that one for about 25 years. So let's just look at momentum and trend. Two simple colors sitting at the bottom of my screen. When it's red, it's bearish. When it's yellow, it's neutral. When it's green, it's bullish. All right. And ultimately, what I want to remember is not just what the current reading is, but where did we come from? And this history is something unique. Most traders will look at what the read of an indicator is now. But in something like this, when we're looking at momentum and trend, it's really important to see what it was preceding shifts. If I have a neutral momentum and neutral trend, yellow over yellow down there, but I see that we were green over green, I'm bullish neutral. And I'm always going to defer to continuation over reversal. You want a high probability, you want two high probability ideas? Bears are on television, bulls make money. And yes, I'm not going to hedge that statement at all, right? The other thing is, in terms of looking for reversal versus continuation, favor continuation. This is not about an always statement. This is about probability. If something were to happen 10 times, I want it to at least be 6 or 7 out of 10 that I'm going to see that probable outcome. Continuation over reversal. And again, bears are on television, bulls make money. I've never in my trading life met a profitable, successful, and happy pessimistic trader. Most of the traders that I know that are trading even bigger than me, millions, if not hundreds of millions of dollars under management, my mentors, where I want to go in my trading career, I'm 30 plus years in, optimism and staying positive works. All right. Don't let folks fool you. Pessimists sound experienced. It's just jaded, gang. It's not going to make you money. And case in point, when an overall uptrend north of the equator in the bullish hemisphere pulls back, buy it, right? And in a neutral environment, adjust those trends to something a little bit more conservative. It might be a historical volatility level. I like my daily price movement ranges. If we end up with a trend once again, which we don't have right now, then I can use a 34 EMA wave. But for now, I'll use the daily price movement range. So even this crazy day, but it ultimately yielded higher highs. It's not enough to say, okay, Rag, I get it. Momentum is neutral, trend is neutral. That's only the first part of the automation. The second part is what zones are ultimately valid. We talked about this in the Sector Secrets Mastery going into the close. Microsoft's a big deal when it comes to weighting an XLK, and that then leads to expectations about what the S&P and the NASDAQ futures are going to do. If I take a look at Microsoft continuing to climb the daily price movement range in a neutral environment, most traders will say, oh, we've sold off and that now is a downtrend. Negative, Ghost Rider. This is a mean reversion. Take a look. Bullish momentum, bullish trend. And then after we go into a yellow, I look at the trend that was, and I favor what? A reversal? Only if I hate my money, I'll focus on continuation. So I know I've thrown a lot at you here. I wanted to show you with data and the price and the history of rate cuts that now is the time to be bullish. If you don't want to be bullish, that's fine. Maybe you have a different outlook. Maybe you have a different set of data points. Share them with me. I'd love to read them, right? But I'm going to share with you what I've been doing for over 3 decades that, again, probabilistically works. We continue to drive higher. This is a continuation move. In Microsoft, we're going to continue to likely drive higher. The thing that could upset the apple cart is if we have an abrupt shift in the quarter point expectations for the March, May, and June meetings to be dovish ones. We can measure this. If you join me for Charts and Coffee every morning, you know that one of the things we look at regularly is the CME Fed Watch. This allows us to look at a rate of change understanding of expectations for each one of these meetings. As long as the tallest column represents the quarter point cut, which is exactly what we see, I'm going to expect dovish policy on those meetings until these columns show me otherwise. All right, I know this is a long video, but if you have questions, type them below. Thank you as always for smashing that like button, and I'll see you in the next update.